All right. Welcome back to QuickBooks. We are now going to be diving into chapter 3, which is going to be additional customer transactions. So, yesterday we got to take a look at how to deal with customers, how to add them in, but also to enter them in as a sales process, right? We understood that there are two different types of forms when it comes to dealing with customers, right? We either give them a sales receipt, which is when customers pay at time of the sale, or we give them an invoice, which customers pay after the time of sale. So with that being said, this is now a continuation of chapter 2, and we're going to be taking a look at what other aspects we can look at when we're dealing with our customers. So this is where we're going to see what we have to do when a customer decides to return a product back to us. So as you can see, we scroll down. Here are recording customer returns and credits. So in QuickBooks, it's a pretty standard issuance of a credit memo. All right. Credit memos are only used if a customer decides to do one of the following. Okay. So as we see here, they either want to cancel an order or cancel the order itself. So therefore, denying the order or, stopping the order. Okay. Another one would be if they purchase the item and they don't like it, or they actually decide to do a refund. And then other ones are going to be, if in case for any reason that it is a defective item, we either issue them either a credit, so then next time they come back, they can redeem their credit. And other ones is if they overpaid, then we give them, we write them a check saying, hey, you overpaid the statement. Okay. Other ones too is if you look here, when a customer overpays, or when they've already paid ahead of time, but they're making a refund and we have to issue them a check back. Now, of course, with that means there's multiple ways that we can actually distribute or assess this this credit memo, right? We can either if they haven't paid yet, we can apply it to their invoice. We can give them a full refund and write them cut them a check and say, here's your money back. Or we can actually say, or if they want us to, we can actually retain it as a future credit that can be applied to a future invoice. So most cases, most customers just want their money back. But those are the three options that you can do when it comes to doing a credit memo. And then I'm going to talk about one more thing that we are going to be using a credit memo for, and that's actually to write off bad debt. Now, before I jumped in there, let's go ahead and focus on the main important idea here, which is issuing a refund, okay? So as you can see here, our first thing that we're going to be looking at is Mr. Bob Mason. So first off, I believe we have to create an invoice first. I'm going to open up the Customer Center, go to Customer Center, and then choose all from the list of below, and then we're going to select an invoice, double click on invoice number 3947. So let's go ahead and take a look at that. Okay, so the invoice already exists. So I'm going to go to my Customer Center on my home page. All right, and we're going to go ahead and take a look at Mr. Bob Mason, who is our customer. So Mr. Bob Mason, here he is. We're going to take a look at all of his transactions. And then we're going to be looking at invoice number 3947. So by double clicking on that little invoice there, Um, as you can see, it's popping up some other stuff. It shows here that he actually ordered an invoice from, or we actually processed an invoice for him, that we made a purchase for him, that we bought 30 items, right? We bought him standard photo paper, right? He bought 30 packs from us, okay?
Yeah.
Now, he wants to return 10 of them. All right. So therefore, we need to issue a refund for this invoice. Now, this invoice has been paid, as you can see right here. He's already made a payment to this invoice. So therefore, we have two options that we can actually technically give. We either give him a full refund, or we can either retain his credit for a future purchase. But in this case, we haven't gotten there yet. So now the question is, how do we issue a refund? Okay, and there are a total of 7 ways that you can actually issue a refund. All right. So I'm going to go ahead and close out of this real quick, just so then I can actually, well, first one and first most is going to be on the actual invoice itself. If we go at to the very, very top of the window, you have a button called refunds/credits. That's exactly what we're looking for, is this button right here. Okay, so that's one way. Again, I'm going to close this just so that we can show you the other ways that you can be able to issue the refund as well. Is here it is. First things first. Again, always on the home page, you have the button refunds and credits. Okay. You can also find that on your customer menu bar. You can issue a refund. Just I have to find it. Let me see. Where are you? Okay, so create, enter sales receipt. Create batch number. Okay, receive payments. And here we are.
Did you want to create a credit memo?
Yes, create a credit memo. Yes, that's exactly what we're doing. So there you go. It is right there. Create a credit memo. Sorry, I was looking for refunds. So here, create a credit memo. There it is. Okay. And of course, same thing. If we are in the customer center, right? Any way you get to the customer center, you are going to go to the new transactions, and you are going to issue a credit memo right here /refund. All right. And of course, same thing too. I can do the same thing if I were to even right click on a person as well. You can create a credit memo right here. Okay. And the same way it goes here. If you click on manage transaction, you have the credit memo option right there. So that was a total of 6 ways already. The last one would be could be found or should be found on your income tracker. You go to the income tracker, of course, you have all of your invoices here. Manage transaction, you do have the credit memo/refunds button right there. Okay? Since I am already here in my income tracker, I'm going to go ahead and click on that credit memo/refund button. And here you go, a similar, if not identical, type of form pops up. Okay, so here's the 7th way. So now, because I didn't do it directly from my invoice itself, therefore I have a lot of information that I have to pick and choose from. So in this case, that's completely fine. You don't need to have the information, because as long as we know what the invoice number is, and as long as we know who the customer is, you should be able to locate it, no problem. So as you can see, I'm going to go ahead and type in my customer, Mr. Bob Mason. Okay, and his whatchamacallit, his class, I think it's San Jose. Okay, San Jose. All right. Now, because I don't have the information in front of me, what you can do is you can pull up the invoice so you can see what I am trying to do. But in this case, because we got to take a look at it, he purchased 30 standard photo packages from us, right? So what we're essentially going to be doing is we are going to be recreating the same thing except we're doing a refund. So the item here is going to be the standard photo package. Okay, and it is for 10. The quantity is for 10. And instead right here, what we're going to do here is because we know our invoice number is the 3947, we're going to go ahead and tack on a letter C for credit. Just like how every other invoices, this is our reference point that we're not creating a stream of credit memos. This one is directly associated to an invoice. Okay, so I'm going to go ahead and, of course, I'm going to say in the message, thank you for your business, even though like he's making a return. You have to be respectful to your customers. If they don't need it, they don't need it. So, and I'm going to say refund 10 photo packages. Oh, yeah. Photo paper. I'm sorry. Photo paper. Did I put photo paper in here? Standard photo.
Oh, you need to change that.
Oh, yeah, you're right. It's standard photo paper. Okay. All right, there you go. And
Matches.
there you go. Now it matches, right? So now I'm going to go ahead and click Save and Close. And once I do that, now I'm going to get that window on what to do with this credit memo. All right? You can either retain it as a future available credit for a future purchase. You can either give a refund or you can apply it to the invoice. As we know from this particular credit memo, right? He's already paid for this invoice. He paid it in full, and now he's just returning our stuff to us. So in this case, we can't apply it to an invoice. That doesn't make any sense because he already paid for it. So our only options is either we retain it as a credit in the future for us to apply for a future purchase, or we actually give him a refund. In this case, we want to give him a refund. That's what he wants. He wants his money back, so we say, okay, I will write you a check. So once you've done that, right, and this depends too, you can either write a check. Most cases, writing a check is going to be the best way to keep track of your transactions. But if you're doing this at a store, you know, people are going to want either a store credit card or they just want their money back cash up front. So you're going to have to make that executive decision whether you can do it or not. And in this case, I'm going to go ahead and write him a check. Okay, so here I'm going to write him a check. See, so I wrote what kind of method am I doing? I'm paying him in check. And I'm going to pay him for $133.80. For what date is it going to be?
2/15/2019.
Okay, exactly 2 years ago. All right. 2/15/2019. All right. We're going to make sure that the name on the check is Mr. Bob Mason. Okay. And this also gives us a little heads up, like how much money we have in the bank when we're taking it out of our checking account, right? And it's going to be for San Jose. His address is there. And then this is the memo number, okay?
Okay.
All right. And then I'm going to go ahead and click OK. And I get that beep of approval, okay? So now that I've done that, then that is how you do. That's how you issue a credit memo or a refund. Simple as easy as that. It's just exactly how we enter in a sales receipt or an invoice, except in this case we're filling out what the idea is for the credit memo. So any questions in regards to that? That's like the easiest one that we can look at.
No, I don't think so. I mean, it does list them all and it tells you how to do it. So
Mm-hmm. Okay.
the only one it didn't talk about was the income tracker, like you were saying, and that's what all that was about.
Yes. So again, the income tracker, right? Since he already paid for it, it's not going to technically show up on there just because the income tracker here, right, only shows us our open invoices, invoices that have been already, or not, no, I'm sorry, invoices that are open, like haven't been paid yet. So that's the one thing that you can't do or see on your income tracker, right? And there's no way that you can filter it in a way, I mean, except for here, right? You can filter it like based on your vendor, things like that, or who paid and who didn't. But in this case, the income tracker, you're able to do the same transactions anywhere as long as you don't need to you don't need to go on the invoice directly and click that refund button. You can just go ahead and type it in as long as you know what the invoice reflects. If you don't know what the invoice reflects, then that's where you're going to have to go back to your invoice to refer. Okay. So if I did do that, right, then what's going to happen is that it's going to transfer the information directly into it and it fills it in for you. So in this case, I didn't do it that way because, you know, I know what he bought from me and I know how much he's returning. But in most cases, if you are doing this on a daily basis or to other customers, general rule of thumb is you don't want to make that extra mistake. So best bet is to go through the invoice and clicking that refund button. Okay.
Mm-hmm.
All right, but yes, the income tracker, yes, you can filter it that way if you need to see it this way. But again, in 2018, the income tracker is a new idea. Again, I don't really use it as much as it says, but since I was already there, it was only, it's only convenient for me to go ahead and just do everything here. Okay. So now, any questions in regards to the credit memo?
No.
Okay, cool. So now that we got to take a look at that and we wrote a check out to Mr. Bob Mason, there is one more thing that you can recognize. Oh, let me go ahead and let's go ahead and take a look at that. Okay, so when we go to our customer center once again and we click on Mr. Bob Mason, notice this. Your credit memo pops up right here as well. So if in case you need to print it or anything like that, just double click it and you can see the exact credit memo right here. And it even tells you that you even issued a check too.
Oh, okay.
Yes. So good. So so we know for sure that has happened. And we can also double check that by looking in our check register. Did we actually send out a check? In most cases, the check is most likely pending in the, it's probably pending to be printed. But okay, so there you go. So again, that's the cool thing about QuickBooks is that everything that we do, right? Every transaction that's involving, whether it's a customer or whether it's a vendor, it's going to be listed here on your customer center, right? And it gives you every single transaction that, oh, why can't I make this bigger? There you go. There you go. So again, and the great thing is that because we did make that little sequence or reference number point, that this credit memo is dealing with this invoice number 3947. C just stands for credit, right?
Mm-hmm.
So other than that, that's how you can go ahead and make a good reference point there. Okay. So so in your book, it tells you this. You can also use a credit memo to write off bad debt. So that's why I was talking to you earlier above there, saying that these are the main reasons why you would use a credit memo. But the second and last thing that you can use a credit memo is to essentially write off bad debt. So in this case, it's going to be when we're looking at this kind of method to use it as a credit memo to write off our bad debt, we do need to understand a few things prior to that. Okay?
Okay.
So before we dive into the actual lecture, let me go the example here. Let me go ahead and give you a little background information on bad debt. So when we're dealing with bad debt, it's essentially when we come to the conclusion that one of our customers decides to just not pay us and will never pay us. Okay. And the assumption here is that because we allow them to owe us the money, therefore, if they're never going to pay us back, we just have to safely assume that we have to take a loss. It's a bad business, practice, but it's reality. Okay. It's the reason why a lot of companies, or especially corporations, because of the IRS allows us to write off at least 5% of uncollectible debt per year. That makes the corporations very happy because then that's also a tax break, right? 5%. You're letting me take 5% loss without no penalties for that. That's a very, very good deal. But it's very bad for the businesses because if you're potentially just writing off 5% every year of your total sales, it just at the end of the day, your company's not making any profits. It's because of that underlying notion that you're not really getting the money that you're supposed to be receiving. Instead, you're just writing it off as a loss, saying you're never going to get that money back. And at the end of the day, then that company will fall through the holes, and go bankrupt or just go out of business because they're not making money. So that's also one of the dangers and risks when it comes to allowing your customers to be able to owe you money, especially when you have no collateral, right?
Right.
Exactly. So with that being said, understanding to that when customers fault on their payments. Now, this isn't like when a customer calls you and says, "I'm not going to pay." You're going to exhaust every single way, method, and your time too to try to collect your money. Um, and So, like, they're going to be sending you letters. They're going to be charging you finance charges, right? For all these late fees and stuff like that. Any way to try to get your money, they're going to keep calling you saying, "Hey, you owe us money." Now, since the major corporations, they have the big bucks, they usually, they outsource it and sell their accounts receivables to other companies or debt collectors to collect the debt for them. And essentially, of course, that's just the easy way out. They don't have to, they don't have to deal with these customers who owe them money because it's someone else's problem now. Okay? And with that being said, you know, um, that's just not that's also another not a very good business practice to do. If people owe you money, go be responsible to collect it. Don't send someone else to do your job. So, but in this case, that's just reality, and that's in real cases, in real corporations, that's what happens. Okay. But in most cases, when we are dealing with our own accounts receivable, we have to understand that the IRS has rules and guidelines. Most businesses, they allow them to take at least, I'm sorry, not at least, the maximum of 5% bad debt write off every year. Okay, and that's actually a lot. Thinking of it as a major corporation, if you're taking 5% off of $1 billion, that's a lot.
Mm-hmm.
That's a lot of money. But then again, that's the risk that you have to take, because a $1 billion corporation such as Walmart, that allows every like almost anybody to get allow them to have the eligibility to have a Walmart credit card. You know, you can only assume if you're giving $1,000 to a million people, that's already 1 billion people that can owe you that money. Okay, so with that, it comes to risk, and so in order to write off bad debt, there are two methods that exist. One is going to be the direct write-off method, and that's what this book teaches you, is to directly write off the bad debt. Now, I've also mentioned this before, and quite often, is that the purpose of QuickBooks is for tax purposes. So therefore, that's exactly why they teach you the direct write-off method, is because, QuickBooks is meant to be a tax program. It's meant to be an accounting tax program for the purposes of the tax accountant. But it also is a dual feature, because it also allows the regular accountant to go ahead and manage their daily transactions without having to file taxes, okay, or without using QuickBooks for the purposes of taxes. So I'm going to teach you the book way because that's what you're going to be tested on. But I'm also going to show you if you are planning to, apply for a, any job, and let's say you are the general accountant, I'm going to teach you the other method, which is called the allowance method, which allows you to to properly write off bad debt, okay, and following the rules of GAAP. And this isn't directly writing off the accounts receivable. You're actually going to be creating another account until you make an adjustment entry. So again, hint the word adjustment entry, which happens at the end of a given period. Okay, so there's two methods I will tell you. One is for the tax accountant, and the other is for the regular accountant. Okay? So in your book, it teaches you the tax accountant way, also known as the direct write-off method. Okay? So here it says that we are actually going to go to our list and menu and select list. So we're not going to do that. We're going to first, 3 things that you need to make sure that you have. All right? Very first thing is you need to double check to ensure that you have the appropriate account that exists. Okay, so for in this example here, we need to make sure that we have the bad debt expense account. So I'm going to go ahead and show you here, because that has to come first. Is in order to write off your bad debt, you need to, I just put depreciation. I'm so sorry. Bad debt. All right. Here we are. Just by searching it, you do have a bad debt expense account. Okay? Bad debt expense account. Good. So at least we are accomplished with step number 1. Okay? Now the next step is now creating a bad debt bad debt item. Okay, so in this case, let's see, do we have a bad debt item? I do not believe so because it says in your books that we have to create one. All right, so I'm gonna double check just in case I missed it. I don't believe we have one. We have to create one. It's going to be an other charge. So other charges, no, we do not have a bad debt item. So let's go ahead and create that bad debt item so then we can go ahead and proceed with the next step. All right, so how we create a new item, we go down to the bottom and we're going to click new. All right, and it's going to be an other charge. So other charges. Okay, and what is this item going to be called? It's going to be called bad debt. Okay, so there you go, right there. Bad debt is going to be my my account. This is not a sub item, so in this case, or part of an assembly, so I don't need to click on that. And now I need to associate it or link an account to it. There is no percentage on it yet, and it can be taxable. All right, because again, in our sales forms, we do include tax, so it could be taxable. All right. So here we are at account, and it's going to be for the bad debt expense item that we ensured that we had. All right. So let me see. Let's double check our book. Is this exactly what I need to create? All right. It is not. Oh, I have to fill in my description to write off bad debt. Okay.
Yes.
Ooh, to write off bad debt. There you are. Okay, no percentages, no amounts need to be taken away. So make sure that you don't do anything. It's because when we write off our bad debt, it depends on how much the value is, or et cetera, et cetera. So I'm going to go ahead and click OK. Now that I have that OK and I see my bad debt item right here, I am now ready to go ahead and move on to the next step. Okay. So I'm going to go ahead and take a look at this. So first thing is that we are actually going to be taking a look at we're going to be obviously doing a credit memo, but first thing is we need to establish who is going to be faulting on their payment. All right, I believe it's an Anderson Wedding. What's his name? Something.
Kumar Sethi and Naveen.
Yes, that's them. So they decided that they're not gonna ever pay us back. Okay, and let's go ahead and let's look at that particular. There it is. Let's go ahead and take a look at their particular invoice and let's make conclusions from them. Okay. All right. So, So Anderson Wedding / Kumar and Naveen, right? So let's go take a look at that in here. So if we were to go ahead and it's this one, Kumar, Sadi, and Naveen, right? Invoice number 4003. Let's double click on it. Let's go take a look at it. We've issued this since December, okay? And retroactively, we're supposed to be in February. So it's been 2 months and this person has not even made a single payment to us. So let's look at the amount carefully. How much do they owe us?
$90.
They owe us $190 even. Okay, because they ordered 2 hours of photo sessions. Okay, 2 indoor photo sessions. It's been 2 months and I haven't seen them make a payment to us. So now I can go ahead and safely assume that they're never going to pay us. I've already exhausted. I sent an email to them, or I sent a letter to them, and I'm requesting my money back from them. But now I'm already down. It's already been 2 months. Realistically, I'm not going to get a payment from them. So I'm going to go ahead and click that create refund / credit at the top of the window and see if I do it directly from the invoice. It just carries the information over and it brings it to you like this. Okay?
Okay.
But in this case, what I'm gonna do is I'm gonna obviously change the date. Okay. The date is so February February 15th, and look, it says 3948C. I do not want that. It needs to reflect whatever the invoice's number is, which is 4003, and then you can go ahead and write C. Now, again, C stands for credit. That's just the generic term, or whatever you want to do it, okay? If it works best for your company to create a different number or a different mnemonic device to associate this is a bad debt, then put a B, right? B for bad debt, or D for debt, C for credit, R for returns, or revised, whatever you'd like to do it, okay? However you'd like to do it, but in this case, the book says make it a C, all right? So 4003 C. Now, here, it's showing me that I have the indoor invoice. I actually have to get rid of that because I'm no longer getting that. I want to create a bad debt item, right? So in order to write off the bad debt, we're going to go ahead and associate and link this with the bad debt item. Okay?
Okay.
And then it says, gives you an error message saying this item is associated with an expense. Yes, we know that. Okay. All right. So then once we come here, now my amount is 0. But because I have my invoice right behind it, I can take a peek and look at it. But I know what it is. It is going to be for the 190, right? It was 95 times 2, right?
Mm-hmm.
Okay, so 190 even. All right. Obviously, quantity is going to be 0, and my you need to change this because it's not taxable, right? It's going to be a service item. All right. So let me go ahead and double check that if my screen matches the screen here, that we ensure that this invoice is going the way it is. So here it is a service item, and it's for the credit memo is a service item. Oh, it says it's 1. Okay, I'll go ahead and do 1 for the item. Since, yeah, that way it shows it as one item. Okay, 1 item at 190, and because it's not taxed, it won't tax you based on here. However, let's say you do have a taxable item in here. By selecting that you have the tax on there, what happens is it reverts the tax on there too. So make sure that's just a little fun fact on the side, just in case you are refunding a product or you're trying to write off a bad debt. You also need to associate that if there's tax involved. By you selecting that there's tax involved, it calculates the tax based on it, and it will calculate it and take the tax out. So in this case, I have my bad debt item. I have for the quantity of 1 service, and it's for 190. And in this case, I have to thank you for your business, but in this case, I'm not returning. I am actually going to say I'm going to say here that this is to write off bad debt. All right. And I'm going to go ahead, make sure everything looks good. And no PO number, just this number right here. And I'm going to go ahead and click Save and Close. Right? And then now you have the options. You either can retain as a new credit, give a refund, or apply to the invoice. Because we are writing off the bad debt, we need to apply it to this invoice. And I'm going to click OK. Once I say that, it's going to give me this window. Which invoice are you wanting to apply this, this credit memo to? Straightforward, we want it to the same one for the 4003. And I'm going to click I'm going to click on this, so make sure it's checked marked, and I'm going to click done. Okay? Now, here we are at the very same invoice here, and notice this. What's my value at this invoice here?
Talking about your balance due, or are you talking about?
Yes.
Yeah, okay, yeah, it's 0.
Exactly. All right, because we applied the credit to this invoice. So what we're essentially doing here is we are writing it off, and we're writing it off as a loss. Right? Your bad debt expense is going to be your loss right there. Okay? So that is how you do the direct write-off method. Okay? Any questions in regards to this? It reduced, we found a way, right? Because we were outstanding $190. Now we found a way to use a credit memo to reduce our accounts receivable. And now we have an invoice applied with the credit. Now we have an invoice that reflects our amount that we want, which is 0. Okay? All right, so I'm going to go ahead and save and close. So now, if we come back to our little customer center here, my Sadi, Kumar Sadi, and this one right here, the account balance is now 0. All right, and if we come to the transaction here, we have an invoice, and we have your credit memo right there. Okay. All right, so that is for tax accountants only, all right? Because with the rules of GAAP, they don't want you to write off bad debt right away. They want you to exhaust every possible method to try to collect your money. And then when you come down to the very, very end, that's where you can go ahead and safely assume that you'll never, ever going to collect that bad debt, and you can go ahead and write off the bad debt using the bad debt expense item. So, with that being said, I'm going to go ahead and now show you the proper accountant way to do it, the one that you're supposed to do on a regular daily basis instead of at the end of a given period, okay?
Yeah.
So, and because you most likely, if you are going to be a tax accountant, you have to actually pursue your CPA unless you're doing tax at a lower, for private sector, obviously. But if you are, because majority of tax accountants are actually CPA licensed, so it is it's a huge department under the accounting, or a huge concentration to just do taxes for people. Okay, so with that being said, I'm going to go ahead and show you how to do the allowance method, right? So let's go ahead and start back to square one. Right? I told you there's a list of the 3 things that you need to have, right? Before you can go ahead and get started. So let's start with step number 1. You need to create the allowance for doubtful accounts. Now, we already have a bad debt expense account. I don't need a bad debt expense account because I'm not going to use the direct write-off. I'm using the allowance for doubtful accounts, or It could be also known as allowance for bad debt, bad debt allowance. Whatever your company makes sense of it is what you're going to be utilizing. And what essentially a bad debt expense account is it is a so many ises. It is a contra account. All right. It's a contra account to accounts receivable. Now, what does a contra mean? It means the opposite account. So in this case, what we're essentially doing is we're creating another account to place in as a placeholder to hold on to bad debt that is potentially going to become bad debt. Okay? So it's not bad debt yet. But when a customer, seems like they're not making a payment, or we're trying to reach to them saying we're trying to collect debt from them and they refuse to respond for us, we need to make sure that we take that amount that they owe us, place it in a placeholder for temporary until we can confirm that it is valid enough for us to write off the bad debt. So we call this the allowance for doubtful accounts. It's a placeholder because our assumption is that they are in limbo. They haven't made a payment yet, but it's not bad debt just yet. It's debt that will potentially can become bad debt. In this case, the allowance for doubtful accounts, when we create the account, you have to just know that the reason why we need to create it is a placeholder, but it's also a potential for us to also redeem our accounts, redeem the debt. Okay. So it's not completely forgone at all yet. Okay, this happens during the year when you have somebody that faults on their payment, but given their circumstances, they still have a potential to continue make payments. So again, with this pandemic, right? A lot of people are going to be under the allowance for doubtful accounts because we don't know when they're going to get their job back. But that doesn't mean they're not going to pay. Does that make sense? Because maybe some people, if they haven't seeked out professional advice or whatnot, or they haven't been, it's the word that extends you further when you owe something, and they extend you. That word. Yeah, that word. They give you they give you an extension.
Yeah, they're tagging it on the end.
Yes. They're giving you extension and saying no, you don't need to make any further payments until that. It's like for something. Okay, so now that we have that idea, right, we need to create the allowance for doubtful accounts. So I'm going to go ahead and create a new account. So we're going to go ahead and create a new account. Now, this account is actually going to be an other asset account, okay? Because essentially, this account is, again, we're using it as a placeholder. We can't create a second accounts receivable account because realistically that's not what it is. It's a contra account. So in this case, we need to go here and we need to select that it's going to be considered an other asset account. All right. And we're going to go ahead and click continue. So again, there are many ways that you can determine what this account can be called. And it could be in terms of bad debt allowance, but in this case, I'm going to teach it to you as allowance for doubtful accounts. Okay? All right? And here I'm going to say to write off potential bad debt or potential uncollectible, or no. Let me erase that. So to write off uncollectible debt. Okay, so if someone owes me money, this is a place over to for us to be able to write off the uncollectible debt. Okay. I didn't look at my account numbers, but let's make it 19,500. Okay, since it's an other asset. All right, and I'm gonna go ahead and click enter. All right, so there it is. I have the allowance for doubtful accounts. It is 19,500 allowance for doubtful accounts. So that's step number 1. All right. So now let's go ahead and move on to step number 2. We need to create an allowance for doubtful accounts item. So now we got to go to our items. And where do we go to find our items? Where's our items list?
Sorry, I was taking notes at the same time.
No
I can
worries.
go to the list.
List, good. List. We're going to go to items list. Okay. So now I'm going to create another item. Same, just as creating their bad debt expense, right? We are going to create another other charge. And this time I'm naming this account as the allowance for doubtful accounts. Ooh, my typing's so bad. There you go.
No, Hector has a good class on that.
Accounts. There you go. Allowance for doubtful accounts. All right. And what account am I going to link it to? Same thing. We're going to link it to the allowance for doubtful accounts that we just created, 19,500. All right. And I'm going to go ahead and click OK. So here it is. I've created my item. I have my bad debt item, and I have my allowance for doubtful accounts item. Okay. So now I'm going to go ahead and create a fictitious invoice, so then we can go ahead and show you the example. Okay. So let's go ahead and pick on somebody. Who do you want to pick on for a customer? Okay, because we have to create an invoice before we can create our, okay, anybody.
Oh, let's just go with Mr. Fang. Dr. Fang.
Okay, Mr. Tim Fang, okay? So let's go ahead and create an invoice for him. Okay? So here he is. I don't remember what class he belongs to, but let's just say San Jose. All right, that's the one that we've been seeing quite often. He belongs to San Jose. Okay? The date, let's say this is back in December. Let's say December 24th, Christmas Eve, okay? And let's call his invoice, let's call his invoice 4150. Okay, because back in the day, it was that. It wasn't 2019-01. It was whatever numbers, okay? And let's say he bought from us, outdoor photo sessions. Okay, outdoor photo sessions. And let's say he bought 2 of them. Okay? All right. And let's say he got 1 outdoor and he got 1 indoor. Okay? 1 indoor. As you can see, these are all service items, okay?
Mm-hmm.
That's fine. Because if you do a taxable item, just make sure that you do follow the law, the line that make sure that it does match it 1 for 1. Now, for this instance, okay, let's go ahead and do that. But I'm thinking you don't have to do it. But yeah, there you go. We have it just like that. Okay. And I guess I should properly do this. Thank you for your business. Thank you for your business. And 2 outdoor, 1 indoor. Photo session. Okay. And okay, good. Everything else looks good. So he owes me $285. Save and close. Okay. Now fast forward, right? It's now February, right? It's been 2 whole months and he still hasn't made a payment to me. So I'm gonna go ahead and double click on his invoice just so then I can take a nice look at it. And it says past due. All right, we've administrated and tried to contact him and he still has not picked up. So now I'm going to assume that, you know what, maybe he's having a rough patch in his life. So I'm going to assume that it's not for surely bad debt yet. I still have a potential to redeem it. However, I'm going to place it in another placeholder for now until he makes a payment. So then when I run my reports, it doesn't show or it doesn't make my assets overstated, okay? Because I'm supposed to be pending too much money when he's a potential, he might not pay me back. So of course, here, of course, with the date, as we know, it's going to be February, let's say it is February 24th or 25th, February 25th. And his invoice again is going to be $41.50 with a C, all right, for the credit. And then now I'm going to go ahead and I'm going to actually clean all this up because again, you don't need the custom photo or anything like that. It's going to be bad. I'm sorry, it's going to be the allowance for doubtful accounts. Okay, I can clean up this photo session because essentially they're all going to go into one place. You don't need to have 2 lines for the same exact thing unless you have one item that's taxed and one item that isn't. So there you go. Here you go. I put that there and I'm going to say he got one of everything except for the second line. Second line doesn't count. And we know he owes me $285. All right, there you go. Just like writing off the bad debt. And this time, 2 outdoor and 1 indoor. I'm going to go ahead and make a note here saying this is to write off bad or uncollectible debt. All right, just exactly identical to the bad debt expense item, but this time I'm transferring it into a placeholder account. All right, and then I'm going to go ahead, save and close. All right, so then I get that same window saying, what do you want to do with it? I'm going to apply it to an invoice and I'm going to click OK. And here it picks up the first invoice, which is the $41.50, which is the one that we selected for Mr. Tim Fang. And I'm going to say, yes, done. Now that I have that, here's his invoice. And it said it's been paid off, which it has not really. But as you can see, my account balance now is 0. Okay. And now, if I actually go to my, so if I close this out, and I actually go to my allowance for doubtful accounts, so let me go ahead and no. Okay, just in case. So I'm going to click this. There you go. And I'm going to go to my chart of accounts and I'm going to go ahead and take a look at that allowance for doubtful accounts. So I have to go look for it. It is an other charge. Oh, I'm sorry, it's an other asset. And it's 19,500. Here we are. And then look, my account balance for right now is $285. If I double click on it, it's for $285. All right. And again, if I look at my accounts receivable, it would also shrink that as well. Okay. So again, what happens at the end of the day is that you're going to actually create a journal entry. Let's say Mr. Tim Fang is a lost cause and he's never going to give you your money back. So you need to write off the bad debt. That's where you're actually going to create an adjustment entry, all right? Because right now we need to transfer everything that's in the allowance for doubtful accounts and zero it out, or in this case, we need to zero it out so we can confirm that it is truly a bad debt. So when we do that, we are essentially going to create a journal entry, right, to go ahead and write off that bad debt expense. All right. So for the 285, what you're going to do is you are going to debit your bad debt expense account, and you're going to credit your allowance for doubtful accounts for the $285. Okay. And that way it gets written off your books completely and you took a loss for $285. But of course, I'm not going to show you that because chapter 13 is all about adjustment entries. Okay.
Okay.
That's just one step that you have to do. But I mean, I can show you right now. So let's say at the end of February, right? You have to write off your bad debt. Then you're going to go ahead and make a journal entry, and you're going to clear out the bad debt for the 285 by making a journal entry. Okay, so make a journal entry. Did you have a comment out there? What was that?
No.
Okay.
I was just saying, you don't have to show me that right now if it's really out of context.
No. The reason why I'm explaining to you is because the one thing that it is because it is kind of out of context as well, is that unfortunately you're done after this. You don't get the accounting section. You don't get to know beyond this. And so I have to explain pretty much two things at one time. So yes, so when you come here, you're going to actually have to debit your bad debt expense account, and you're going to have to credit your allowance for doubtful accounts to write off the bad debt that Mr. Tim Fang has. All right? And that's how you end the transaction. So at the end of the day, your bad debt expense will eventually happen. It's just that's how you're going to do it. You're not, because right now, you're not going to be able to create another credit memo because you already wiped out the debt. So you have to make an adjustment entry here to confirm that Mr. Tim S. Fang isn't going to pay you, period. Then you have to write off, and the proper way to do it is by doing a general journal entry to completely write off the bad debt. All right? So yeah, and that's how you do the allowance method. All right?
Mm-hmm.
One is for tax purposes only. The other is for actually doing it as a regular accountant, something that you need to do on a daily basis, or in this case, during the period, and you're allowed to do it because it's governed by GAAP. Okay. Any questions in regards to learning anything about the bad debt item?
I think I've got it with my notes.
Good. All right. So again, if you want to write it somewhere in your book, you can make a note of it on there. So instead of creating a bad debt expense item or a bad debt expense account, right? You're just going to have to make sure that step number 1, create the allowance for doubtful accounts. Number 2, create the allowance for doubtful item. 3, if you need to have an invoice, then create the invoice. But then the next thing you're going to do is create your credit memo. All right? And then that's it. All right?
Okay.
Good.
Okay, I think I got that.
Good. All right. So now that we got to take a look at our credit memos, the next one is going to be, let me see, I think this chapter is very short. The next one is going to be creating customer statements. So this is going to be the fun one, okay? Because it allows you to send reports to your customers when they have overdue balances, or you just want to send them a friendly reminder of their activities that they have with you. So customer statements is just like exactly if you own a credit card, right? The credit card company is going to send you a statement of the list of all the activities that you use on your credit card. It's going to also facilitate how much interest that they charged you and what your current balance is. And they're also going to attach a bill to it saying, hey, don't forget to make your minimum payment. So that's the same thing here. We're going to be doing the same thing here, and we're going to be sending a statement with the amount of that's going to be due for the next invoice. All right. So how we create customer statements is pretty straightforward. You have statements right here, but there's not that many ways that you can actually do it. There's only about 3 total ways to make statements. Okay. First one is right here on your homepage. It's pretty straightforward, standardized right here. It's on the homepage. Second's going to be on the customer's menu bar. You can create statements here as well. So right here, create statements. All right, that's way number 2. And then the last way is you have to go to your customer center itself. Okay? And the last and third way is you're going to actually have to right click on your customer and create your customer statement that way. Okay? Create customer statements. Where are you? Create customer statements or statements. There you go, create statements. Okay? You don't have it on your managed transactions. You don't have it on your new transactions. So just know that part right there, that you can't create customer statements through that section. You can't and you can't even run a report because that's not what I'm asking you. I'm asking you to create a customer statement. So the only 3 ways is your homepage, your menu bar, and when you're in the customer center, you can create it by right-clicking on the customer. All right? Nowhere else. Not even on the income tracker. Okay? So with understanding that, I'm just going to go ahead and do it on my homepage so it's easier for you to, find. So here we are. We're at this little window here. Now this window is actually pretty, it's a pretty good. It does what it does. Okay. First thing is we got to recognize, when do you want this statement to reflect? Most cases, most if all not statements, they usually happen or they usually entail the last day of the month. So in this case, my statement date is going to be, I believe it is going to be March 31st, 2019. And what is your statement period going to reflect? I want it January a lot of clicking I have to do. January 1st, 2019 to March 31st of 2018. Now notice this, they do recommend you to Actually, I don't know if I mentioned this before, but best recommendation is you never want to type in your date. You always want to use the little calendar right here to select the date for you. Okay, so that's why I have to do a lot of clicking. Okay, so again, January 1st all the way to March 31st. All right, and that's going to give me, so basically what I'm doing is I'm doing a quarterly statement, right? I do it every 3 months of the list of all the transactions that a customer can, has done, right? The activity of the customer. And again, so who do you want to send it to? Do you want to send it to all customers? Do you want to send it to multiple customers? Do you want to send it to just one customer? Or do you want to do customer of a specific type? We talked about this before, right? Are they commercial? Are they residential? Or do you want a preferred I'm sorry, that's going to be the next one. So do you want to send it to all your customers? Yes. Or do you want a preferred send method? We want it mail, of course, but I want all my customers. Okay.
Okay.
Now it says right here you can view your customers. It's unnecessary unless you want to view your customers. But in this case, I'm going to make sure I send one to every single customer. Now, here's the catch. So on the right side, you need to also fill these information out to ensure what information you want to send them. So very, very, very top, we got template. Obviously, we're going to be using the Intuit standard template here. I believe we have an Academy one, but in this case, it's just right now it's only in Intuit. All right. So now I'm going to start going down through the checklist. So the first one is going to ask you create one statement per customer. Yes, of course. I want one for each customer. Now, the next one is show invoice item detail. So if I do select this, that means every single item that they purchased from me, it's going to give them a description. Of course, most statements you want to give as much information so then a customer doesn't come up to you and say, what does this photo package mean? You know, it includes a lot. It includes every detail. Okay. Do you want to print the statement by billing, address, zip code, and stuff? Of course, you want to print that on there. Okay. Other things are, do you want to print a due date on the transactions?
Absolutely.
Absolutely, yes. That's most cases. A lot of statements have the due date on it. Yes, you want to also ensure that your customer knows that they've made a payment. All right. Other things here is, do you want to? Okay, that's it. So then now here's the catch here. Do not create a statement for. Okay, so these are conditions. Do you want to create a statement for people with zero balances?
I wouldn't think so.
Of course, no. You don't want to bother people who haven't even, done a transaction. That's a waste of paper.
That's an expense to you anyway. So.
Exactly. Right? Do not create a statement for people with zero balances. Do I want a balance less than? No, we already selected that we want it for zero balances. Okay. Do you want it with no account activity?
If it's an open account, that would be, I think that would be up to your management whether you wanted to send them one.
Yes.
If you have no activity, it might just been, well, you haven't had any activity in 5 months, but that doesn't mean they're not going to start using it again.
Absolutely. But another thing too is that's also another waste of paper there.
Because
if they have zero activity and you're sending them a statement, I mean, that's kind of the idea too. If they haven't done business with you for 5 months, you don't want to bother those customers. But you do want to send them promotional, advertisement things and that to try to,
Right.
bring them in. But in this case, no, I'm not going to bother people with no account activities. And lastly, for inactive customers, of course, you don't want to bother people you haven't even talked to for years.
Right.
All right. So no, do not create a statement for inactive customers. All right. That's also another waste of paper. So now that I've done this section and I'm pretty good and I have what I have, I'm going to go ahead and take a preview. So right here, you could go ahead and preview your statement. So as you can see here, we have a total of 1, 2, 3 statements. We got, okay, and of course it's right now it's really small, but you can go ahead and use that little magnifier and it will tell you here, you have one for Miranda's Corner. You have one for for Maria Cruz, and then you have one for Bob Mason. All right. Those are all your customers that have balances. Okay. Everybody else that's on that customer list has 0. Okay. So there you go. And then if you notice here, let's take a look. Here's their dates of transactions that they have, and it's in detail, right? You bought a lens, right? Or what, this is Miranda's Corner. They bought a lens from us, one of them at $321. So it gives you the account and invoice details. And of course, at the very top here, they have the amount due, and they have the balance right here. Okay. And of course, let me see if I can look at the bottom. The bottom says here, of course, you have information that they are current. Okay. Let me see. 130-day past due. So they have nothing that's past due. 30 to 60 days. He does have something that's been overstated for 3 months, for 30 days now. And then here they have the amount due for $910. Okay. So again, because he has overdue or past due stuff, that's where you can go ahead and finance a charge on him. Tack on an additional payment for him. Okay. So in order to do that, I'm going to go ahead and exit out of this. So that's just a preview, right? So now you have the little window right here that says you can assess financial charges. So as my statement says, right? They owe me money, and they've been owing me money. So I'm gonna send them I'm gonna tack them on a little fee because that's not cool. I've sent you in your invoice. I've bothered you enough. I'm gonna now tack on another additional charges here. So of course, when I click that, it says, do you want to set up your, yes, you do want to set it up. So again, it brings up this little window here, again, your preferences. And this is now, we are at finance charges. So let's take a look at what our options are. Okay. So first things first is, what is the amount of interest rate that you want to charge them? I want 10%. Okay, I want 10%. Okay, minimum financial charge. I'm gonna leave it at 0. Grace period. How many days of grace period are you gonna allow them?
Usually it's 30.
Usually it's 30. I'll say, you know what? I'll be generous and say 30 days. I'll give you 30 days, no financial charge, but then after the 30 days, you're gonna get charged. Okay. And then finance charge account again. So this is going to be, it's going to be interest income to us. Okay? Because again, this is our customers, right? If they're not making payments and I tack on an additional fee to them, that means it's extra money to me. So there you go. Interest income. Interest income. Okay? Not interest expense. You're not spending money to charge them. You're charging them to pay you for owing you money. So there you go. So now that I have that, so now how do I want to actually calculate the charges? I could do it on one date, on the due date, or I can charge it on the invoice and billing date. In this case, it's usually on the due date. All right. And then make all finance charges invoice to be printed. Yes. Yes. I want all my, actually, no. Actually, in this case, no. I don't want my financial charges to be printed. I want it to show it on their statement right now. So then I'm going to go ahead and click OK. So then I'm going to get the second window here that says, well, what do you know? You got 3 people who owe you money. So are you going to tack this 10% finance charge on them? And here in this case, let's take a look. Miss Maria Cruz, her branch opening, she owes me $3,365. So therefore, 10% of that, for some reason, is $600.
Yeah, that doesn't compute.
No, it does not. Same thing here. The 700 for the 100. Okay, so it's because it's based on. Remember, we gave the grace period. Maybe there's an invoice in there. There's an invoice in there that hasn't been outstanding for over 30 days. So because we do have that 30-day grace period, that means whatever invoice that we just sent out and it's their first time offense, then we block it off. We say the next time. So if it's any bill that's overdue for the past 60 days, that's when we finance the charges. So in this case, that's a lot right there. Okay? And of course, now that I have that, they're marked all. So I'm going to go ahead and I'm going to assess these finance charges. All right, I got that beep of approval. So when I click my preview, it should appear on their statement right here under okay. It doesn't say it right here. It should say that finance charges should be here. Oh, I'm sorry, down below.
I was gonna say it should be down below. I would
Yep.
think, but
Yeah, it should be down below. Let me try to see. It should say, there you go. Finance charges.
usually it's the last item on a statement.
Yeah, usually it is. But in this case, they tacked it on the list of things that they had to pay for. Okay. So there it is. Okay. And the amount due now has increased because of that finance charges. Okay. So now that we have that, that's how you finance those charges, and that's how you tack it on to their bill, and that's how you go ahead and you're going to click that print button and send the invoices away. All right. All right. Any questions in regards to tackling down the statement charges?
No, that's pretty straightforward. That's probably one of the most straightforward things there is.
Yes, right? So I'm going to go ahead and click this close button because I'm not going to print them or send them out. So, all right. All right, so when we come back, we have a couple more things that we're going to be looking at, such as dealing with our sales tax and et cetera, et cetera. So with that being said, right now it's exactly close to 3 o'clock. I'll just call it at 3. And today, just go ahead and take a 15-minute break. So be back no later than 3:15.
Oh, okay.